Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for a weekly update of the stock market, and we have got a lot of things to talk about today. So this is going to be a long one, so go and get yourself a cup of coffee, a cup of tea, settle in. I will probably have to timestamp this video, but I want to try and cover absolutely everything today because, as I've been saying for weeks, if trend breaks, we have to give the bears their due and we have to change our outlook and consider other possibilities. Now, this does not mean that the sky is falling, does not mean it's the end of the world, it does not mean that the bearish count is invalid. But when things change, you have to be prepared to change with them and change your opinion. So we're going to look at everything today, see how all the counts stack up, see how the rest of the TA stacks up, try and weight things fairly and evenly, have a rational and reasonable approach to what's going on in the market at the moment. Now, if that sounds interesting, feel free to stick around. Like I said, this is going to be a long one, but before we begin, a quick word about the many benefits of becoming a member of the Green Star Trading Patreon. If you already appreciate the work I'm doing on YouTube and wish to show your support for the channel, then why not join Tier 1 for just £5 a month? You still bag yourself an exclusive video each week that won't be available on YouTube. Or why not consider joining Tier 2 for just £10 a month? You still get the same exclusive video each week, but you also get access to the public Discord. There are multiple channels where you can discuss things to your heart's content on multiple subjects with all other Discord members, including myself. You also get access to the entire back catalogue of my educational videos, including the Elliott Wave series, plus other technical analysis videos, including trading and trading risk management. I also host a live session each week via private link to the YouTube. Then finally, Tier 3 for £15 a month. You get all of the previously mentioned benefits from Tier 1 and Tier 2, but you also get access to my monthly dividend calendar where I list my stock picks for the month and all of the relevant ex-dividend and payment dates. You also get access to my stock rating system, which is an at-a-glance rating out of 30 based on company health, value and overall dividend quality. If you yourself wish to look up a specific ex-dividend date or payment date, tag me on the Discord and I can look it up and get back to you. Also, if there's a stock you're interested in and you want me to use my rating system on the stock that you have chosen, tag me in the Discord and I will get back to you with a score. Thanks for listening, guys, and now back to the video. Okay, welcome back, guys. A quick note about the Patreon. If you are considering joining up, you are most welcome, but I would suggest maybe leaving it now until the start of February, because you get charged the first time you join the Patreon and then the start of each month thereafter. So if you were to sign up now, you'd only be getting 6 days worth of value. Now, I put this on all my YouTube videos, I say it in my YouTube videos, I put it in the description of my YouTube videos, I have it on my Patreon as well explaining that. So if you choose to sign up, I'll take it as intent that you wanted to do it now, and I will not object to you paying me twice in succession. I will give you 24 hours grace if you sign up at the end of the month without appreciating that fact. But that's it. So you've been warned, and I'm doing my best to save you money and give you maximum value. So just keep that in mind. Right, before we get into the nitty gritty today, all the Elliott Wave counts, bullish and bearish, all the technical analysis we want to cover, how the trend is broken, what that might mean, and all these other things. I want to start by just getting something off of my chest and speaking honestly and openly with you for a minute. Because if there's one thing I absolutely despise, and this might become a rant, if there's one thing I despise, it's the fucking drama. I can't stand it. We are here to trade any asset, any time frame, long or short. Right? So if you're screaming the sky's falling, get a grip. And if you're screaming by the dippy dip dip dip, just get a grip. Okay? Nobody cares whether you're right. Nobody's impressed by your attempt to sound clever. Drop the drama and just fucking trade. Or don't. But don't start telling people this is the end of the end of the end, because we've heard it for 200 years straight and the market keeps going up. Don't keep telling people to buy every goddamn dip that comes along, because Elliott wave has a habit of completing larger wave degrees eventually, and dips become corrections, and corrections become bear markets, and bear markets can last for years. It's not as simple as the sky is falling or buy the fucking dip. We're here to trade, not spread drama and hysteria. I hope that has not caused offence. It was not my intention to do so. But I just have to be honest. The Twitter sphere is a toxic cesspit of idiots. The YouTube comment section, apart from on my wonderful videos with my wonderful audience, is a lot of the time filled with equally stupid, mindless, drama-focused individuals. The reason the guy on the street corner is wearing 2 weak unwashed clothes and has nowhere to go, and he's holding a cup in his hand with a sign round his neck saying the world is ending or the end is nigh. Yeah, we don't listen to that bloke, and we don't weight his predictive power above our own analysis. And that's exactly how we should treat anyone who's behaving that way. Now, it could be the top of a major cycle wave. It could be the top of a super cycle wave or a grand super cycle wave, and you might not have stock market returns positively for the next generation. That's always going to be a possibility, and one day it's gonna happen. But guess what? Larger wave degrees complete, and future generations will look back when they're higher up in the chart, look back at perhaps the lost decade or 2 lost decades and go, God, we're up 5 times since then. That's also going to happen. Okay? So how about we focus on what the chart's telling us, we trade when it's safe to trade, we manage risk, and we keep an open mind. There you go, guys. Rant over. Let's get on with business. Okay, so we've got our rant over with, and now we're going to take the opportunity to actually start doing some analysis. So I want to start here on the Nasdaq, since the counts seem to make a little bit more sense here. We're going to start with a bearish count, 2 bearish counts, and then we're going to look at the bullish count. Okay, because trend is broken, but the bullish count's still valid. Elliott wave has its own rules about that, and we'll look and make some measurements and basically consider all of the options. So, excuse me. Let's start with, tell you what, we'll go back to my oldest bearish count, which is from months ago, and we'll bring that whole thing up. Okay, so this originally topped out here, since I hadn't updated the count. All of this is the same, so all I've done is change the wave structure of this final move up to accommodate a higher high, since I hadn't updated this count. Now this is a very bearish count. Okay, super bearish count. Doesn't matter how you how you look at it, trend's broken. If we take a regression channel for the whole move up since March 20 low, we are way more than 2 standard deviations away from the mean. We are more than 3 standard deviations away from the mean at this point. So this is either a 99.9% probability, or should I say 0.01% probability that this is still part of the same trend, right? Or there's a 99.9% chance that it's broken that trend and something else is occurring. So the simplest way to think of this, using our wave 1 to pivot back here, and if we just bring our regression channel back up to signify this, and we'll move it, because we've got data down here which obviously isn't in the channel, so we'll unlock it, and what we'll do is we'll move it to the start of we'll move it to the bottom of the wave 2. Okay, so as you can see, we got a dip, 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 and every single dip was brought up. So as I said in my little rant, the buy the dippers, right, are right by virtue of being in a bull market, or in a shorter term case, such as we have here, being in the midst of an impulse wave, right, where every dip's going to get rewarded. But not all dips are equal. Not all dips are equal. This dip is not sitting on any trend support. Okay. So buying the dip is a sound policy when you've got obviously repeatable, observable, reliable support. Okay? When you have not, you are dealing with a different animal. So in that sense, not all dips are equal, right? Now long term, there'll be a bigger trend. There always is. This is why the market over 200 years has only gone up. There's been 90% corrections and less, but it's only ever gone up. So the question then becomes, if this is our pivot at 1 and 2, and this is the subsequent trend from that pivot, something finished here, right? Something is over here. So what is over? Well, the simplest possible conclusions you can make is that the 3 related to this 1 and 2 completed here, or the 5, and there's a third and fourth wave within this trend, and the 1 and the 2 pivot, rather than just holding the subsequent wave 3, holds all of the trend to the top. Those are your two options. We've completed a corresponding 3, or we've completed a 5, and at that point completing a 5, depending on the wave degree, means you're in a 1 or a greater cycle degree correction. So let's just consider the most bearish circumstance for a moment. Let's call this the Harry. We'll call this count the Harry. Let me just put that on that. If you don't know who I'm referring to, then I'm not going to result in defamation and say the man's second name, but you probably know who I'm talking about. So we're talking about the Harry here, and this puts us primary wave degree in the most bearish way I can count it, completing a cycle wave 5, primary intermediate 5, cycle wave primary 5, cycle wave 5, super cycle 3, which means the subsequent correction is correcting at super cycle degree level. Now if that's the case, this is not going to be over in a week or a month or a year. It's going to take years and years and years to get through, maybe a decade or longer. Okay. We've had those corrections before in the stock market though, so before people start screaming once again that the world's over and it's never coming back, we've had lost decades. We've had more than lost decades. We've had a lost generation in the stock market before. Okay, when larger wave degrees complete, what they don't correct in price, they correct in time. I say that all the time. It's absolutely true. If we're completing a wave 3 at this degree, then the wave 4 is going to be a more time consuming correction, because the corresponding wave 2 to this count was a bloody sharp and violent sell-off. Okay, so we would expect an alternate pattern to emerge here at wave 4, a more time-consuming correction. Okay, it will still be deep, but it's going to gobble up a lot of time. That would be my assessment. As I said at the start of the video, as I said during my rant, we trade long or short, and there's going to be up and down moves the whole time. Even if this is the most bearish scenario, it doesn't mean you can't make money in this market. It will never mean that to a trader. So in that sense, that's the most bearish case. Now if that's the case, where will a wave 4 at super cycle degree finish in? Well, we're expecting a shallower correction at this degree, but a very time consuming one. Now shallow for super cycle wave in my mind is still going to mean probably 50%. So selling off half of the entire value of the market. And like I said, I'm putting on my bearish hat long term here for the moment, and we're considering the worst case scenario. So completing, what does a wave 4 tend to complete within the bounds of in Elliott wave? A wave 4 will very likely complete within the bounds of a prior wave 4 correction of 1 lesser degree. This is cycle wave. That's super cycle wave. This is cycle wave. Here's the wave 4 at cycle wave degree. We could expect the super cycle wave 4, once it's over, to complete somewhere within all of this price territory. So that could mean we come down and we do a zigzag and we come down into here. That's a pretty sharp and quick correction though. So maybe we go 1, 2, 3, 4, 5 A, B, 1, 2, 3, 4, 5 C, into an A of a triangle, into a B, into a C, into a D, into an E, and we're putting a triangle for the next decade or the next 5 years or whatever. Okay, time consuming, gonna take years. Okay, that's the most bearish case I can see. The extreme, it could be a flat, right, which would be even more, would provide actually more opportunities to traders, but also at the same time for the average investor would be more heartbreaking, because you could end up with a 5 move into an A, into a B, into a C, into an A, into a B, into a C to new highs, and then 5 waves down in a C. That's possible as well. So you see what I'm saying? If we are starting a super cycle wave correction, and the bears with the sign hanging around the neck, the end of the world is nigh, screaming at everybody on Twitter and the YouTube comment section that the sky's falling, it's going to be falling for quite a long amount of time. In fact, they're going to be well out of breath before the end of it. So thank God they'll be quiet at least by then. But either way, my point stands. There are so many insane numbers of opportunities during all this period of time to trade the market on any setup you see available to you, short or long. Right? So it's never the end of the world, even when it's the end of the world. And it will still end eventually for those long-term investors. Now, if you're in your 60s, this kind of sucks. But if you're in your 20s, who gives a shit? Right? You got, what, 60 years ahead of you? This will be over in a decade or less. Maybe a decade or more. It's still nothing, is it? You've still got plenty of time. So it's all about perspective. So that's me having put on my most bearish hat. This is not the count I subscribe to, but we have to give the bears their due. The possibility of the market topping out is a possibility. So there you go. That's uber bearish count number 1. So let's move on to my preferred interpretation of the bearish scenario. If this bearish scenario were to play out, this would be my preference for it. Okay. My preference has us in the bearish scenario, if this is correct, of having completed a primary one up here. The problem I have is that if we're saying cycle wave 5 is over, then it completed in less than 2 years. A cycle wave 5 completed in less than 2 years of what is now a 12-year bull market. I'm not saying that's impossible. I'm not saying that's not possible. Just seems a little short is all. Just seems a little short. So what about the probability that we haven't even started at wave 3? Okay, now if I had to pick between those two bearish scenarios, this one would be my preference, which is that all of this is a completed trend but into a 1. Okay, with 2, 3, 4, 5 way up here to go until we complete cycle wave 5 of that larger super cycle degree. Okay, now at this point you could still expect to retrace 50% to 61.8% of this entire move up. Okay, however, I will put a pretty massive caveat on that and say go back for the last 12 years. Feel free, go and do it right now. Well, not right now, watch this video, but later on the Nasdaq or on the SPY, and go and observe all of the pivots which have occurred in the last 12 years in the ongoing bull market. Find the subsequent wave 2s and tell me how deep they are. The traditional Elliott wave assessment that wave 2 should be between 50 and 78.6%, or often targeting the golden zone of 61.8%, has literally not been in play for the last 12 years. I have seen wave 2 after wave 2 after wave 2 come in seriously shallow. seriously shallow. And not just any time during the last 12 years, just recently. If we take the first pivot we can find off of the March 2020 low, how shallow is this? Right, it's just a little over 23.6%, somewhere between 23.6% and 38.2%. So the classic Elliott wave assumption that the wave 2 is going to be a big ass correction isn't necessarily going to be correct. You know, if we go and look at, I think the SPY count's probably a bit better for that. Here's another wave 1 and 2. Okay, here's another 1 and a 2. Here's another 1 and a 2. Here's another 1 and 2. Here's another 1 and 2. And if there's one thing you're finding here time and time again, is that these corrections are not big. That's 38.2%. Okay, this one's more substantial. That almost makes the 50. This one makes the 50 as well. And this one, whether we take it from there, that's 38.2, or if we take it from there, it's a little over 23.6. So the tradition, so 50 is big enough. We've done it a couple of times, but we've done 38.2, 23.6 a few times as well. But the point I'm making is not as deep as you might be inclined to believe. Right, not as deep as the golden ratio that we seem to always expect. Now, over the long-term history of the practicing of Elliott wave, the golden ratio for wave 2s has come into play more often than not. But I would argue that in the money loose, or the loose monetary policy of the last decade or so, with endless stimulus and QE, that the corrections have been consistently shallow, between 20 and 30 odd percent, very rarely 50%, very rarely 61.8%. So the assumption that you're going to get a deep 2 could be wrong, but let's just assume for a moment, keeping our bearish hats on, that you do get a deeper retracement. Well, let's have a look. I have trouble getting the count to complete up here. End of story. I've managed it with the Nasdaq, so let's do it with the Nasdaq. But with the SPY, I have serious problems getting the count to conclude at that high. So let's use the Nasdaq here instead. We'll come and deal with that issue with the count later. Like I said, this is probably going to be a long video. So far, we've retraced a little over 23.6%. Okay? Let's shift this into a wave 2. Here's the 50. Right. If we came back to the 50, that would be confirmation that this was a larger correction at a larger degree, and that the bullish count would be officially dead as we've interpreted it at that point. Not this long-term bullish count, but the bullish count we'll cover later. We'd have the advantage of having come over here an invalidation point where the wave 1 was, but that we'll talk about that later. Focusing on the bearish count, so however we get down here, 1, 2, 3, 4, 5, A, B, C. Let's say we got down to 50, right? To complete a wave 2. Then from top to bottom, peak to trough, we'd have given up 30% again. Pretty much like what we did back in March 2020. Okay, so that's one way of looking at it. We give up 30% of the market. If we were to make it to the 61.8%, the golden ratio, we would have given up 37%. Pretty sizable correction. Okay, but nowhere near as bearish as the first scenario we were talking about, which could go beyond 50% of the total market value and then take years and years to complete. Significantly more bearish than this interpretation. This could still be nasty, but wow, it would be an absolutely amazing opportunity to get in long again once this was over. Or to trade it short after the B wave completes, in my opinion. I'd rather see 5 waves down done and a retracement before I shorted this. That would be my personal opinion. I mean, what you do is up to you, but I would not be shorting it at the moment. We are very oversold and we bounced like buggery yesterday into the close. So we'll talk about the specifics of how to get through these counts once we cover them all in general. So there's the 2 bearish counts. Right, we've topped out at super cycle degree 3, cycle wave 5, super cycle degree 3, and we're about to lose a decade plus of time of going nowhere. And probably won't see highs again in that time. New all-time highs. That's the most bearish I can be. I'm not bearish enough to say 80 or 90%, because I can't find grand super cycle wave high up here. But if you can, and that's your count, and you think that's going to happen, follow your own analysis, but don't go out into the street, in this case the internet, with a board around you saying the end is nigh, because as I said previously, nobody's impressed and nobody cares. So that's the bearish count, or counts, and I prefer this interpretation. So now we've done that, we've covered bearish count 2. Alright, so now we've done that and we've covered the bearish counts, let's try and find evidence to support the bearish case from a technical perspective. Alright, so the most obvious one, and the one we've already covered, is that we've broken trend. Okay, as I pointed out before, this dip is not equal to previous dips. All of these dips had strong trend support beneath them and were good buys, and anyone who knows the saying, you know, the trend is your friend, and was following it, was doing the right thing. You stick with the trend until it breaks. We discussed how we can break down the two different counts. We're looking at the one I favour. So, bar the break of trend, is there anything else we don't like the look of here in the Nasdaq? So let's bring up our daily moving averages. First time since the collapse in 2020 we've broken the 250-day exponential moving average. Okay, now traditionally when looking at this average, with the moving averages I use, my ribbon is the 10 will cross through the 20, it will approach the 60, it will either breach it and then turn around, or it will bounce. That will be synonymous with a trend that's still intact. When the 10 and the 20 break the 60 vigorously and continue lower, and the 250 breaks in price, that's confirmation that that trend's over. Right, now like I said, where, how, what trend? The 3, the 1, whatever, that's up for debate. But that trend is been confirmed dead. So let me show you what I mean. Like, so the 10 and the 20 crossover, right, head towards the 60, but then they bounce. The 10 and the 20 crossover, head towards the 60, but then they bounce. The 10 and the 20 crossover, head towards the 60, breach it, back test it, bounce around it, but then bounce. 10 through the 20 to the 60, then bounce. 10 through the 20 through the 60, then bounce. 10 through the 20 through the 60, out of the trend, price finishing below the 250. Very different. The last time we saw that was back in March of 2020. So we went 10 through the 20 through the 60, price below the 250 here, and then continued to collapse. Much more bearish. So we haven't done that since then. So that's another feather in the cap for the bears, right? We can't take that off of them. That's bad news. Right. Freaking amazing effort made yesterday to close the day positively. It was phenomenal. You know, you're only going to get a pop like that, you know, where we go from being bearish for the day as a candle to being extremely positive for the daily close of a candle. You're only going to get a turnaround like that if idiots were selling the bottom. That's pretty much it, really. If people were coming in and selling the lows, that provided liquidity for that to actually have a significant effect on the market and provide the bounce we saw into the last couple of hours. So I don't know why, but yeah, people must have been selling into the lows. You know, it's not that uncommon. It happens all the time. Actually, it's what retail's there for, isn't it? Yeah, the whole point is that you start a sell-off. You're going to have a counter trend move to test previous resistance. Previous support will become resistance, right? This is your bull trap. So the bulls come in, buy here, right? The sellers get screwed who came in here. They get bear trapped. They get stuck. They provide liquidity. The bulls come in. They get stuck in a bull trap. The bears bail, realizing that the market is recovering, but they're wrong. It's back-testing trend. The bulls then see this come back, provide even more liquidity to the pressure of sellers coming into the market, having backtested support, then we collapse. So the whole point of this setup is to just fuck as many people in the arse as humanly possible, right? So you want to fuck the bears, you get trapped down here. Best way to do that is to talk them out of their shorts by coming back up, and then you want to fuck the bulls by coming back and taking out this pivot. That's it, see? That's what the market does. That's literally what it's designed to do, is to take suckers' money off of them as often as possible and hand it over to people who don't make these stupid decisions. That's what it's there for. Now, if you take offence, I'm not trying to cause offence. I'm telling you the truth. This is a life lesson you need to be aware of. Don't be the sucker who sells the low, right? And don't be the sucker who buys the top, right? You're giving the people who want to offload onto you what they want, which is the opportunity to escape the fate that you're now in. Okay? Learn from it and don't do it again. Now, hands up, who's done it? My hand's up in the air. I've done it. Right? I've been trading for years, but we've all done this. We've all made this mistake because we've all been novices. So I'm not being arrogant or being a prick. I'm just telling you the truth. Been there, done that, won't do it again. Right then. So, carrying on. Bad news, essentially. Support for the bears. Looks like with this turnaround yesterday, now this could be 1, 2, 3, 4, and we continue lower, right? And the guys who sold on the low yesterday will get a relief, and the guys who brought will get hurt. But it's possible that a counter trend move is already underway. It's one or the other, right? In the max pain scenario, would be a counter trend move on the way, because this will hurt the bears who sold at the bottom, and this will hurt the bulls who brought. Yeah, and it will just, yeah, it seems like the most likely because it's going to cause the most damage, and whatever causes the most damage is probably the most likely thing that's going to happen. But there's a chance that it's not done. Right, so that's another argument in favour of the bears. Now let's look at the momentum indicators here. We got to oversold conditions, 21.32 on the RSI. We haven't been that low since the sell-off in March 2020, so perfect place to bounce, perfect place for a counter trend move to what could be a new bear market beginning, right? Could be the chance to move back up in the short term. Oversold conditions. We are still well below the zero bound on the MACD on the daily time frame here, with no sign of a buy signal yet, no sign of cooling off either. But if we see a thrust higher today, you'll start to see that histogram cool down, and a buy signal will likely occur within maybe before the end of the week. You know, that could be misread by bulls as a confirmation of an up move, where it's actually a counter trend move. We won't know until it plays out. Right, could be complete here, right, and we go higher. It's also a possibility, but generally a lot of technical damage done to the chart. So let's move up to, well, let's point out the divergence while we're here as well. So we got divergence between these two highs. Right, now this was a lower high, so we can't count that, but we got divergence between these two highs here and here, which has led to my assumption as a bullish point of view was that this would be the correction and then we'd move on, right? So it was heralding sideways correction. Like I said, if trend breaks, we reconsider everything, and that's exactly what we're doing now. So that played out for the meantime. Next thing, let's step it up to weekly time frame. So longer term bearish divergence, or is it really there? I'm not sure. I can't call it there. Weakening momentum though has been a theme this whole time in the MACD. That's been there the whole time. So there's August 2020, and we've just been getting weaker. So we finally had this thrust lower. So it'd be interesting to see how this translates into the monthly time frame, because I guarantee you there hasn't been a sell signal on the monthly time frame since the 2020 sell-off. There's just no way that's happened. So the only way that's happened is if it's happened yesterday. So monthly time frame, can't see the MACD. Yes, there it is. So that's traditionally bad news. That's a monthly sell signal, and as I suspect, it didn't happen. The last time it happened was March 20, but fucking hell, man, the bounce out of the low in 2020 didn't even get into negative. Oh, it did, sorry. The histogram turned negative, but the price was nowhere near negative territory. Well, the actual MACD was, so that was only temporary. This is already a more negative reading. And we've got the average through the signal on the monthly time frame. No such action has occurred until this moment. Histogram's been in decline with a sudden drop. That's a pretty strong sell signal. Right, but then this was in price, right? You know, in price action, the March 2020 sell-off was a pretty strong sell signal, but it didn't materialise into anything worse. It was over in a flash. So you don't know what could turn this? Well, I don't know what could make this be over in a flash. Maybe Jay Powell comes out, cancels all bearish talk, and immediately starts handing free candy canes and $1 trillion bills to everybody, and we're sorted. You know, bull market for life. But that should be taken, for the moment, honestly as it appears, which is bearish. Monthly sell signals bearish. It's happened before and we've bounced quick. But we shouldn't assume that's the case here. We should just weigh it fairly. When it happens, it's often bad news. You know, here's the crisis back in 2008 when it happened. Here's a significant sell-off here, significant sell-off here. Here's the tech bubble. Right, so this is that again. Ouchie doodles. You know, but opportunities abound. As I've already said, opportunities abound on the short side. Right, so yeah, there's another pretty gnarly sell signal. So we've got a fair bit in the cap for the bears now, supporting their argument. Break a trend, break a major moving averages. What looks like could be interpreted as impulsive price action to the downside, combined with a monthly sell signal. All of this is negative. You know. So let's have a look at the SPY and see how the SPY shapes up. Okay, we have the advantage of the ETF here giving us volume profiling and volume along the bottom. Look at that. Just look at the effort made to turn that green yesterday. My God. That is the highest reading in volume we've had since the crash in March in 2020. Since the breakdown in 2020. It's the highest reading we've had. And that was red. I swear that was red all day, mate. I was looking at that. Excuse me, I'm having a yawn. I was looking at that, and that was a big red bar. And that turned green, must have turned green in the last couple of hours. So that is a phenomenal effort made by the bulls to turn this around. Like I said, the only way that got turned around like that was people selling into the lows, providing liquidity there at that moment for a bounce. It must have been the case. Or I would likely assume it was the case. So how do we look over here? Wow, that on the 500 here, that got us back above the 250 exponential moving average to close the day positively. So a weekly close we have to be keeping an eye on now on the Friday to see if this translates across all indices. Can the Nasdaq drag its ass back above this support level? Can the SPY close above it? That would be interesting. A temporary counter trend move and then a bearish close to the week back below this level, that would be very bearish indeed if that were to play out. So that's definitely something worth looking at. But I'm just not sold on this being over yet. 1, 2, that feels like it should be 3, 4, 5, right? It's possible there's a 3, 4, 5 in here. 1, 2, 3, 4 in here, maybe 5, and now this is the counter trend move that would hurt the most people, right? Back test the trend and then break down, as we've already previously discussed. Was I using a regression channel there? Yes, I was. Or was I using this one? No. Or even a parallel channel, whatever. It broke, as we've already discussed. Trend broke. In this case, we got our backsides back above the 250 in a desperate effort with huge volume coming in to try and save the market from putting in a daily negative close, right? We did everything we could to close it positively. The crescendos in the volume link up with the crescendos of the selling. You know, we've seen this multiple times. As we come down into these corrections, volume tends to increase. Here's an exact low. Here's an exact low. Some of these aren't quite exact, but you can see the trend. Volume increases into the bottom. Well, we had the same back here. You know, volume increased into the low. We had the same back here. So from the standard procedure, you can see how volume peaking into the low here could signify a bottom, right? Could signify a low. Whether it's a counter trend low or a low is to be decided, but that's a pretty big effort made to save the market yesterday. Right, they threw the kitchen sink at that for the last couple of hours. Just curious what that point of control represents for our primary wave 2 idea. fact, tell you what, I think we're going to need some of that corrected data. Bear with me while I talk to myself for a moment. Slightly higher if we just take that. Let's have a look at the trend. Let's have a look at that retracement. Right, so the more established point of control is right on the golden ratio, the 61.8. The shorter term from the March lows is somewhere between the 50 and the 61.8. So this could easily be, and then we move lower if we go further back, down to the 78.6, depending on the visible range. So, you know, finding confluence essentially if we were to start correcting. Okay, how do we look on our indicators? So we had bearish divergence here for the RSI on the daily time frame for the SPY, because the SPY set a higher high before breaking downwards. The Nasdaq didn't. The same's true of the MACD, right? Have we got a sell signal on the MACD for the SPY? Once again, I can't see it. Let's bring it down a bit. No, not yet. It's close, but it's not there yet. No red bar on the histogram, no crossover yet. Interesting. It feels to me that unless we're doing something like this, you know, where we continue higher and backtest the signal here, it feels like this wants to cross. The Nasdaq is probably leading the way down, and the broader market will follow the tech sell-off. No guarantee of that, but it feels like that's set up to give you a sell signal on the monthly. Once again, another bearish sign. Hasn't happened yet though, so we can't call it until it happens, but bearish nonetheless. Moving average support in play, but it broke. You know, it broke, like I pointed out, the 10 and the 20 cross, moved towards the 60 and then bounce. If the 250 breaks, it's a different story. Same here. 1020 to 60, 1020 to 60, 1020 to 60, so on and so forth, so on and so forth, so on and so forth, so on and so forth. Then the price breaks to 250 with the crossover in place. That's traditionally a bearish sign because you're completing a larger trend. Okay, so there's the evidence for the bearish case. So let's move on again. Alright, so now we've got to consider the bullish case. We looked at the bearish case. We've given them their due, as we rightfully should given the circumstances, but we have to also follow Elliott wave rules and be practitioners of Elliott wave, and therefore the bullish count is still very much valid. Okay, so the issue we've got here is the scale is becoming problematic, as I won't deny it, it's becoming problematic. Now I've already said, haven't I, that whatever completed up here completed a corresponding trend to this pivot back here. So calling this intermediate 3-4 feels wrong now, to be absolutely honest. Just feels wrong. The only way I'm going to get around that, if I want to maintain an equivalent bullish count, is to upgrade the wave degree. So I think the honest, quickest way of doing that would be to just recount it here roughly. Now I'm not going to fill out all the gumph because I just haven't got the time to do it. So 1, 2. Can't call this intermediate wave logically anymore, but we can definitely call it primary. Okay. Had a discussion with a mate of mine last night on the Discord, DMing each other, who was basically saying, you know, you're not going to get a wave 4 that's bigger than a wave 2, and he's seen it multiple times. I disagree, to be absolutely honest. I have seen larger wave 4s and wave 2s, and the rules are the rules. Now, the trend he's referring to may well be the case. It may well be a matter of probability that is consistently on the side of what he was saying, that wave 4s tend to be shallower than wave 2s. I'll go along with that. But you're making an assumption that isn't necessarily that isn't being supported by other rules. You know, so in that sense, I'd say, yeah, you might be right. Maybe the probabilities long term are on your side, but rules is rules, and we're already considering bearish options, so let's try and keep an open mind towards the bullish options before we put the life jackets on and start throwing babies and women off of the boat so we can escape. Alright, let's just try and keep our shit together until it's time to panic. and then we don't panic, we sell, don't we? We wait for the setup. So somewhere in here, likely here, and likely here with a very long powerful 3, something like that, brings us into what will be primary 4. That would be my best guess, as I don't think my current count, considering it as intermediate 4, is really fair at the moment, or really giving the bears their due. So let's give them their due. So in this sense, we can now say the trend breaking fits. This is 1, this is 2, all of this is 3, trend breaks within the 4 because we're no longer within the 3. And this pivot was not the pivot, very small, shallow pivot for a 2, to set the trend for all 5 waves, but to simply set the trend for the ensuing 3. Okay, it can happen both ways. I've seen it multiple times, where the 1 and the 2 pivot contains the 3, but not the 4 and 5, and the 1 and 2 pivot on larger time frames, in larger wave degrees, often does contain the 3, the 4 and the 5, but you got to be open-minded again, so that's that. So if that's the case, the most obvious call here is that it's done. This is the most obvious call. A, B, C, or bloody close to being done, because this is either 5 waves done or about to unravel as 5 waves. So 1, 2, 3, 4, 5. 5 waves in a C. Big ass C. Way bigger than it should be, but I can't begin to explain how often now I'm starting to see inexplicable shallow wave 2s and extremely long Cs. You know, it's the way this market's built, I think, nowadays. Just so much participation from retail, so much institutional, governmental, central support underlying the market, that you tend to see violent corrections countered by violent moves, and you tend to see shallow pullbacks with endless amounts of support. So, you know, I don't know. Maybe it's time for a revision of some ideas. But either way, I'm still a Puritan at heart, so my Puritan brain tells me that we've got this level until we call quits. Until we call quits, it's 358 spot 76. Move the decimal place 1 place to the right if you want the price for the SPX. This is the SPY. But either way, 358 spot 76 is the invalidation point. That's the top of primary 1. That means 4, from an Elliott wave perspective, can legally come all the way down to here and rally, but not break it. So that's some big ass space. Now, would I at that point be willing to agree with my mate that that is utterly ridiculous in terms of how it looks? Yes, I think by that point I would concede the floor. I would still hold on to the technical rule not being broken, because it hasn't been broken. I'm not going to say it has if it hasn't, but what I will say is that this, if it were to play out, does look ridiculous. Right? If it were to rally before here, it does look kind of ridiculous. But it's not impossible, would be my point, and you can't write it off until it's impossible. So, big ass 4, yes, I agree, unlikely, but probable. Not probable, but possible. So there you go, it could be in. And that huge spike in volume yesterday, that throw the kitchen sink in the market and try and save everybody, that may have been enough. May have been enough. But if it is, you're going to want to see 5 waves out of here. Right, 3 waves back. There's your bull entry. Right. Here's your event STS if you want to. Standard trade setup, giving you a tighter stop. Or if you just like buying pivots, here's your stop and you just have to take on more risk. But whatever. Either way, if this unfolds as 3, it's likely a counter trend move before continuing lower. If this unfolds as 5, then it's likely an impulse. And if we get 3, then we're likely going higher. It's all about the wave count now. How does this subdivide? What targets does it reach? Does it become a zigzag with 1-to-1 relationship between the C and the A? Does it divide as 5-3-5? Does it divide as 5-3-5-3-5? Does it divide as 3-3-3? Does it become a flat pattern? Does it become a triangle? Blah, 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 blah. You take my point. Is it bloody corrective or is it impulsive? Well, we'll find out, won't we? And at that point, you can set up your trade accordingly. You get a retracement, right? You've got your fib levels from the high you can set up, or from the pivot, depending on how you're looking at it. And then if you get a retracement in a corrective move, momentum starts to weaken between these last peaks, right? the A and the C. Momentum starts to weaken, perhaps diversion creeps in, everything starts to roll over. You get your first impulsive move back down and retracement up. That's likely a corrective move, and an impulse is coming down. Right, you get the opposite. You get a strong 5-wave move out of here. Right, that looks perfect. Subdivides as a 5, and then you get 3 back. Right, on low volume, lower volume because it's resuming a bullish trend, right? And then you get the opposite. You get positive divergence here, possibly. You get a slackening selling momentum here, right? Then you get your first little move up and back. That could be an impulse going into a 3. So it's all about the corrective price action now. Is it corrective, flat, triangle, zigzag, or is it impulsive? Is it supported by momentum? How does it look? You know, what wave degree, what wavelengths does it come to? What fib relationships does it hit? Does it run 1-2 and then make a run on the 161.8, making it more likely a 3 within the 1 of the 5th than looking at it as an ABC, which would be 1-to-1 relationship more likely? And all these things are what we're going to look at over the next couple of weeks to try and establish what this is. Now, if we get another breakdown, that makes life even simpler, because then we've got clear 5 down to here, clear 5-wave structures, and now we know, right, that we're coming up into here. We've either finished something for definite, gives us more room, more time, more space to consider things. But if we do carry on from here, we've got to focus on how we come up from here. That's the bullish count as I see it. I'm not going to nitpick through all of this, but I'd have to upgrade that wave degree to be 3-4. Right, so this was a short, sharp zigzag, not very deep. And this was a flat 3, 3, and this is 5 either yet to finish or 5 already done. Okay, that's how I see that. I'll save that and say that's the bull alternate, because I think I've gone off the lower degree count, this extension count. Alright, she says this is 3-4 intermediate degree. That seems very dodgy. That seems very, very dodgy. There's a lot of things I don't like about any interpretation, to be absolutely honest. One of the things I dislike the most about the bearish interpretation is the length of the 3 in this trend. You know, if I just bring that back up for a moment. Where is it? Primary 1 top, we were saying. Still don't know how to get into that. I prefer that as 3 ways rather than this being a high. I can get it with this NDX, but like I said, I just can't get it with the SPY. That leads me into the bullish idea, because I can't get that high to complete, so that favours the idea that this is bullish. I guess by far the most bullish interpretation you can make is that this was 1 and this was already 2, but that seems ridiculous. But you know, if you come out of here like fucking lightning, flying up, that's probably what it was. Can you imagine that? I'm not saying it is, but if we came out of here like rip-roaringly violently higher and smash back into the trend, test prior support for resistance and just ignore it, right, then you might be looking at the start of a 3. In which case the same shit applies as to whether you're coming into a 5 or whether you're coming into a 3. If it's bullish on the shorter time frame, longer time frame, and you're still looking for an impulse to complete and a pullback, right, before you enter. Still applies. But yeah, I do struggle around the top. Now, the thing I was going to tell you, which was what I don't like about the bearish count, right, saying that, I mean, like I said, there's technicals to support it, and I'm not going to ignore them. But the thing I don't like about this is the length of the 3. Right, the length of the 3 falls short of 100% of the 1. Now it's fine because it's not the shortest, because wave 5 was shorter. But wave 5 was bloody short as well. Alright? It's excuse me, I'm losing my voice a bit. It's legal, but it was bloody short as well. Here's the 1 projected from the 4. Don't even make the 78.6. Freaking miles away. The 100 is. So the whole thing, I don't really, I mean, it's legal, but I don't really like how the wavelengths play out, but whatever, might be what it is. Okay, now is there anything else I need to cover before I leave you, good people? Let's come in then and have a look at this correction over the shorter time frame and try and make sense of it. Let's just bring up the wave 3 extension count for the moment, even though we know this is a different wave degree, or we're thinking it's a different wave degree, right? Okay, we're going to need to come down to the hourly. Okay, so bullish heads for the moment. This is A, this is 3 into a B, and this is 5, and we're about to get the 4 and a 5. I don't think the 3 and the 4's in. It doesn't look right. That looks like 1, that looks like 2. This looks like 3, this looks like 4. So that suggests lower after a counter trend move, right? Can't come back above here because that's the invalidation point for wave 1. So let's just throw this down as 5 for the moment. 3 to here, 4 to come, 5 to come down. So let's move the C and the 4. Actually, why am I doing this? Let's just add it to our new count. Bull alternate. Right. So we're saying A, B, C, intermediate degree. This should be. It's correcting at a larger degree. That's A, B, and then this becomes minor. 3, C is going to be here, 4 is going to be here, that's going to be 3, 4. It could be in, but I just don't see it myself. That looks like 5 all goddamn day, that does. 1, 2, 3, 4, 5. Okay, so I can get 5 subdivision here, right? Look at the volume coming in at the low here, though. That's 3 down in the C, fair enough, that kind of makes sense. 1, 2, 1, 2, 3, 4, 3, 4. It's in there somewhere, isn't it? God, it's not easy though. It could be a subwave. I guess that would have to be the only choice I could find. Let's come down to the 15-minute. Actually, no. I think the other idea is better. That's 1. That's 2. 1, 2, 3, 4, 5. It's still going to be 3, 4 here, I think. Very quick 5. Can I take that as the 3 and the 4? 1, 2, 3, 4, 5. Maybe. How do I get down here in an impulse? Not easily, that's for certain. That 2 is that higher? Higher? That high is slightly higher, so maybe 1, 2. Alright then, fine. 1, 2. 3, 4, 5 into the 3. That'll have to do. So this, in theory, should subdivide now as A, B, C to a 4. But it will not come beyond this level here. This is short-term invalidation. So if this breaks, then the idea of the 5 wave down into either A or a completed correction is invalid. At which point it's either a counter trend move in a B, or we've bottomed and we're going up in a new impulse. That's it, really. There's the only 2 options left if we break this level. Excuse me, coughing. Talking too much. Live stream coming up this Friday. So that'll be another 5 hours of me chatting away. I can't bitch though, I love it. I like interacting and having stuff to talk about. Bit of a chatterbox. That's going to be minute. That's going to be minor. Is that right? No, that's the intermediate one. This is minor. Okay, so that's the best bullish interpretation I can get. Bearish, I don't know how to do it on the SPY. On the Nasdaq I can. I don't know how to do it on the SPY, so I'm open to ideas. Because this was obviously, right, 5 waves up. The only way I can get here to be 5 waves into a high is if I go 1, 2, but then drag the 4 to here. and this is a big 4, and I hate that, because then if we fall out of every trend, it doesn't pivot. There's no pitchfork to place here that makes sense of it. Wave degrees are all off, time frames all off, so I just don't like that. I prefer that. 3 wave here, 3 wave here, 5 wave unfolding. Going to find the bottom of the 4 and then bounce. The 4's probably not in yet. How does this subdivide? Well, I can't see the market at the moment, so what we're going to have to do is just bring up the ES1 futures and see how things are unfolding. Okay, it's come down to 15 minute. Now my gut tells me that's a 3 wave move. Right, so if that's 3 waves, right, that's a zigzag. Okay, so your options at that point are A or W, and then you've got to come back 90% or more to find the B, otherwise it's not A, B, it's W. So then that could be a zigzag, and that could be a zigzag, and it could be W, X, Y, something like that. Double zigzag. But we appear to have one zigzag already in place, so we should probably assume WXY, since we have no evidence that we're going to come down in the B wave as of yet, as this doesn't appear to be impulsive. But this is futures data and it's cash data we're interested in, so in that case I'll give it the benefit of being a double zigzag. So we'll say that's one zigzag, probably done. W, some kind of conjoining conjunctivitis, some kind of conjoining pile of crap for an X wave, and then another zigzag for the Y. Could be deep, could be some kind of, I don't know, we'll see. Could even be ABC if we go deep enough as a flat 3, 3, 5. Can't be an overall zigzag because I don't see 5 waves here, unless this is already 1, 2, and we're going to march higher. But there you go. 4 has to come in. If this 5 waves isn't complete, 4 has to come in before this invalidation point here. And then we'll seek out the 5 to find the C, to find the 4. That's primary wave 1, 4 complete. Primary wave 3, 4 complete, and off we go. Significant correction in timescale. Probably a little short for primary, but even shorter if we're talking about, you know, the other count. I was expecting a primary. Oh, sorry, yeah, it'd be impossible to get into bearish condition this early, unless we had that primary 1, 2, and it was all over in a flash. That would be stupendously bullish over the longer term. And we've got to consider all of these things. So there you go. That's in the bull alternate. Right then, the Nasdaq. We have the advantage of a lower high. This makes counting it a shit ton easier. Right, makes it way easier. We can easily say that's a zigzag, and that's a zigzag, and that's a zigzag, and that's a zigzag, and that's a zigzag. So let's just, for the ease of it, let's say that's a diag. Right, that means that this is 1, this is ABC into 2, and we're already down in a 3, 4, 5 to come. This gives us an A or a 1. Most bearish circumstance is a 1, 2 back up, 3, 4, 5, much lower. Less bearish circumstance is an A, back up in a B, down in a C. And that's it. They are the bearish ways of interpreting this. So how can we won't label it until we get 5 waves complete. So the same gig again, except our invalidation point, because we've interpreted the count differently because we've got a lower high rather than a higher high, invalidation point would be here. A move back above this level, you would be testing trend, but at that point it's got to be a V. Cannot be a 2. Well, it could be a 2, but we can't get 5 waves in here, so it can't be a 4 of the 5 wave trend. I doubt it was a 2 either, because I don't see completed 5 waves here. So if we come back up here and break this level, we can't be seeing 1, 2, 3, 4, because we've invalidated at that point. Okay, 3's got to subdivide here as an impulse, right? Because there's no overlap so far. I would either expect that to happen, gives us the 3. Okay. Oh, sorry, what am I talking about? This gives us the 1. Then we can get a 2. Then we can come down to 3, 4, 5. That's the Harry count, the uber bearish count. Or you go 1, 2, 3, somewhere to here, 4, 5, and that's A. Then B. Then C. That's the less bearish count, but still going to be pretty deep. Excuse me. So let's just label this anyway. So this would be A. That's 3 ways all day. B, C. So that's got to be 3, 3, 5 flat. Minute. Then we got to come down here. Now that, could you have an argument for a completed correction? Could you say 3, 3, 3, WXY combination done? Maybe. If that's the case, we'll come back above that invalidation point anyway. So let's just stick it on there, because that's going to help us decide either way. This doesn't look completed as 5. It could be completed as a zigzag, 5, 3, 5, and this is, at which point this would have to be W, X, Y. That's bullish though, and then we're done. So let's give the bears the benefit of the doubt here, since we've got so many bearish technical signals, and say 1, 2, 3, 4, 5 inside of this as a sub wave. So at that point we'll make this even more bearish, shall we? We'll step this down a notch and we'll say 1, 2, 3, 4 to come, and then we'll add in one more invalidation point. That becomes the 3, that becomes 4, which can't go there, and then 5. So where the hell are we? Primary 1, 2, 3, 4, 5. So I'm saying that's incredibly bearish at that point. So we'd be saying A here, B here, C down here somewhere. Intermediate degree. So this becomes the minor degree. This becomes minute degree. Like so. 1, 2, 3, 4, 5. That retreats into the prior wave 4. This becomes a secondary invalidation point at minute wave degree. Here. And this is the invalidation point at minor wave degree. Here. There you go. And that's how it would likely unfold if it was bearish, I think. A big B wave retracement, 5 waves down in a C, giving the bears maximum benefit of the doubt. Thank you for putting up with me going on for so long. Just had a lot to cover. That brings us down to the golden ratio by sheer fluke, but I placed it there. So there you go. 61.8% retrace from the high. 40% sell off overall roundabout. 36%. Okay, and that supports my 1, 2. Anything more bearish than that, right, means that it's 1, not A, 2, 3, 4, 5, and then we're into the Harry count and worse at that point. So there you go. I think I've covered everything here. So let's have a quick look at the VIX. Selling off a little bit this morning, pre-US Open. Big spike yesterday, bringing it above. It depends how you draw the trend. Let's go with this. Right. Taking in 1, 2, 3, 4 highs. Pop above it, back below it, pop above it again. You could also draw it differently. You could say, well, from this high to this high, I think you could argue any downward trend has been broken. A lot of previous levels that are still intact. This pivot here, and this one here, this one here. So yeah, it's a spike, and the rising trend I've been pointing out for months that we are heading towards some kind of future explosion could be underway. If that's the case, I'd not want to put Elliott wave count on the VIX, but that would be an initial move. This would be a bigger move, and then there would be another move, right? Okay, and everything would start to unravel. But still early days here in the VIX, considering previous price data. Well, I say price data, you know what I mean. Considering previous historical volatility, it's early days in terms of the absolute catastrophe which some of the bears are expecting to unfold, but it could. PCC, put the call ratio. I've been following this. This is my own chart using moving averages and my little lines of extreme greed and complacency, extreme fear and panic. The 60 crossed over the 250, and you know we came up to it, backed away from it, through it, back and tested it, and now we're singing. So this could be, as I pointed out in several videos, a slow march higher over many months and years. Even this was, I think I pointed out 600 odd days or whatever the hell it was. Even this seemingly fast move was, 271 days. From the lows here, we've already gone through 341 days. So the process of moving from extreme greed and complacency to extreme fear can take a fair old while, right? Take a fair old time. So in that sense, yes, we can accelerate like that and get this done in a few weeks and get up here fast. So we continue now with a higher low, higher low, higher low, higher low, higher high, high, higher high, higher high. We are in an upward trend towards our inevitable destination. How long we get there, how long it takes to get there, all up for debate. But with the break of trend in the markets, so many technical indicators turning bearish, PCC continuing to climb, VIX elevated, everyone should be on guard at the moment and paying bloody close attention to whatever counter trend move occurs from whenever the low comes. Is it corrective? If it is, that's your bearish setup to short it. If it's bullish, your call. Wait for the retracement, and it's all down to confidence and belief at that point. If it's an impulse, it's a bloody impulse, so you should be buying it. You know, this is not financial trading advice, but if you can manage the risk and get into that trade, then I don't see why you wouldn't, because it could be an even bigger dip, couldn't it? But if it's bearish, then we will, whatever we complete here on the SPY of the Nasdaq, whether this is done already and we counter trend move, or whether we've got one more thrust down before we get the completion, it's all about how we come off of that low. You know, do we come up in a zigzag? Do we come up in a flat? Do we move in a triangle? Right? If you get a corrective structure, it's going to continue lower. It's just going to continue lower. If you come out of here in an impulse, right, smash all this invalidation territory, and then you come back in free, that's likely the correction done. Now, regarding how the time frame, if you get 5 up earlier than that on a smaller time frame and you're more of a day trader and you get the free back and you can see impulsive price action supported by volume and momentum, trade it on a smaller time frame. That's you though. That's up to you if that's how you want to do things. Right, I've been waffling on for what feels like an eternity, so I'm going to call it there. Thank you very much for joining me on this rather long-winded weekly stock market update. I hope I've covered everything, and if I haven't, feel free to let me know. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. As always, massive thank you to my patrons. Your support is greatly appreciated. The live stream will be Friday this week. Haven't confirmed the time yet, but likely around 1 PM GMT, and that's going to be another long session. If you've got any ideas that you want me to look at during the live session, put them in the live analysis channel on the Discord. Brain just went blank for a minute. And if you're interested in becoming a patron, like I said earlier in the video, please consider doing it at the start of next month to save yourself some money and some value. But either way, if you're curious, there's a link in the description box below. You can click on, head over to Patreon, have a read of the tiers. And if you're curious about what the live streams are like, I have uploaded one of them to YouTube just as a taster. That's now available on my videos page on my YouTube channel. Alright guys, take care of yourselves, and I'll be back with you later in the week. All the best. Bye bye.